In this video, we're going to look at the direct write-off method, and then we will briefly discuss factoring and the advantage of credit sales. So the direct write-off method, this is different from the balance sheet method and the income statement method. So the income statement method, or the income statement approach, and the balance sheet approach, both of those are ways for us to estimate uncollectible accounts expense each month and to make an adjusting entry to allowance for doubtful accounts each month. Both of those methods are an attempt to apply the matching principle. But the direct write-off method is a different way of doing things, and it makes no effort to apply the matching principle. So under this method, we don't estimate uncollectible accounts expense ahead of time at all. Instead, you wait until an accounts receivable is actually deemed uncollectible, and only then do you record the uncollectible accounts expense. So the problem with this is a sale might originate in January, and then 8 months later, when you finally determine that that receivable is uncollectible, it's not until 8 months later that you record the uncollectible accounts expense that's related to the sale from January. So you're really not doing a good job of matching expenses to revenues in the periods in which they are applicable. So with the direct write-off method, we don't make any estimates ahead of time. We just record it as an expense when it happens. So because of this, there is no allowance for doubtful accounts used under this method. So your accounts receivable is shown at its gross amount on the balance sheet. So this differs a lot from the other two methods because, one, we don't make estimates ahead of time, so we're not applying the matching principle well. We're not showing accounts receivable at its net realizable value, but instead at its gross amount, and we aren't using the allowance for doubtful accounts. So it almost goes without saying that because we are in clear violation of the matching principle, this is not acceptable to use under GAAP. This is not GAAP approved, unless your total accounts receivable is considered immaterial. So if you're a company that mostly works with cash sales and you really have a small amount of accounts receivable balance at any given time, if it's really considered immaterial, this kind of method would be permissible under GAAP. Because in that case, if your accounts receivable is really small, really immaterial in relation to everything else, if you mostly conduct sales in cash, then the cost of applying something like the income statement approach and the balance sheet approach, the cost of that would outweigh the benefit of applying the matching principle well. But this will only work if it's immaterial in amount. Then GAAP will be okay with that. Or if you are not a public company and then you're not held to GAAP standards per se, then you can go ahead and use the direct write-off method. But again, that won't give you as much information. If your accounts receivable is actually material in amount, you're much better off using either the income statement or balance sheet approach, because then you're doing a better job at matching your revenues to your expenses, and you get a better picture of what your actual income is or net income is in each month. So what would that look like under the direct write-off method? Let's assume you determine that there's a specific accounts receivable of $2,000 that is uncollectible. Well, there's no allowance for doubtful accounts involved. Instead, here you would just debit your uncollectible accounts expense for $2,000, and you will write off that accounts receivable right away by crediting that accounts receivable. Okay, so we're not pulling from any allowance for doubtful accounts balance at all. Instead, we're just debiting that expense right away and crediting accounts receivable. Where with the other methods, when you actually end up writing an account off, you would have recorded the expense related to that write-off in the period in which it originated, when that sale originated. So when that receivable is actually written off, you wouldn't record uncollectible accounts expense again. Instead, you would have debited allowance for doubtful accounts here. But on the direct write-off method, there is no estimate ahead of time, so we would just debit the expense and credit accounts receivable. So the important thing to note here is that here whenever this is deemed to be uncollectible, this $2,000 would be recorded under this method as an expense in the period in which you determine that it is uncollectible. We don't know then, this $2,000, the sale related to this $2,000 receivable could have originated a year ago. So in this case, this expense, although it's originating a year ago, the sale it's related to is from a year ago. Now, a year later, you're finally recording the expense of that. So the expense and the related revenue is really mismatched in this method, where if we were using one of the other methods, we would estimate how much of that sale from a year ago is uncollectible, or total sales from that period is uncollectible, record that expense, that estimated expense in that period, and then when you finally find that something's uncollectible, you don't record it as an expense at that time, but you simply pull from the allowance for doubtful accounts. So that's the main difference here. What about factoring? What is that? So many companies will factor their accounts receivable, and really what that means is they will sell their accounts receivable to another company. Because usually if in normal terms, we have to sit around and wait for customers to decide to pay us finally, right? That's how accounts receivable works. It's a promise of cash later. So the downside of that, of allowing customers to pay later, is we have to wait for that cash to finally get to us. So some companies, remember we said a dollar today is better than $1 a month from now, right? So using that logic, some companies don't have the luxury of waiting around, or don't want to wait around for the cash from their accounts receivables to come in or to be paid by their customers. So some companies that don't want to wait, that want cash right away, will sell their customers' debt to another company minus a fee. It obviously costs some percentage of the total accounts receivable. So they will pay a fee to the debt collecting company, or whatever the company is. They will pay a fee to the company in exchange for that company giving them cash upfront right away. So they're getting the full amount of the total accounts receivable outstanding minus a fee. In exchange for that cash up front, the company then sells that accounts receivable to the other company, and then that other company then is in charge of collecting those debts. So the debts are no longer the responsibility of the company. The company doesn't have to wait around for its customers to pay it, because it received the cash right away minus a fee, and then the debt collector will now be tasked with collecting that debt and would be burdened with the possibility of some of those customers not paying. Okay, so the company that sells the accounts receivable, it gets cash right away, but it's not going to get the full amount of the receivable, right? It's going to get less than 100% of the full amount of the accounts receivable. The collector, which bought the accounts receivable from the company, they will receive revenue in the form of the fee from the company. And then not only will they receive the fee, but they will receive the accounts receivable from the customers once they pay. Now, again, this collector, probably there's a percentage that it won't receive on that accounts receivable if some customers don't pay. But again, if the collector can choose to take legal action, for example, if some of those customers default, to actually finally collect on all of it. So the company receives less than 100% of the total receivables. But the nice part about that is, although it's less than 100%, at least it's cash right away in the bank account, and the collector benefits because they collect a fee on top of the accounts receivable that will come in when customers actually end up paying. So that's the benefit of a company actually factoring its accounts receivable. It's cash right away. You don't have to worry about collecting debts from customers. That's a burden that is lifted in exchange for a fee. And then what's the advantage of credit card sales? That's how most companies do it, right? Some companies don't extend credit to customers themselves through accounts receivable. Instead, some companies will either accept cash, debit card, or allow customers to pay with credit cards. Now, This allows companies to receive cash more quickly. Usually it's not right away. They have to wait a couple of days at least for the credit card companies to finally remit the amount of the sale. But it's not free, right? That amount of the sale won't be in full. The company has to pay a certain percentage fee to these credit card companies in exchange for using their services. But the nice part of it, although it costs money and it can be expensive, the nice thing is that the company will receive cash a lot more quickly than if they were to extend credit to customers themselves. And they don't have to worry about checking up on a customer's credit before they make a sale. And they don't have to collect cash from customers. They are just waiting on the credit card company. And they don't have to maintain an accounts receivable subsidiary ledger because there is no accounts receivable if the company chooses to not extend credit to customers themselves, but instead just allows customers to use credit cards. So I'm sure you've come across some companies that accept cash and debit cards and checks, but they don't accept credit cards, like Winco, for example. Now, why is this? Well, first of all, it's not free to accept American Express, accept Visa, accept MasterCard, because those companies charge a fee. So Winco, for example, saves money by not having to pay these credit card fees. And the nice thing is because Winco can save so much money on not having to pay those credit card fees, it can return that back to the customer in the form of lower prices of its products. So that's one thing. Winco can attract customers through lower prices. And another thing is Winco, if they only accept cash and debit cards, then they don't have that risk of default from their customers. So that way they don't have to worry about uncollectible accounts, for example. So the benefit of both factoring and credit card sales is it's cash quickly in the bank account without having to wait around to collect debt from customers. With factoring, you still have an accounts receivable subsidiary ledger that you have to maintain because you yourself are extending credit to the customer, but when you sell those receivables, it's the company that you sell it to that has to worry about collections. Factoring is also not free. You pay a fee. Credit card sales, there is no accounts receivable subsidiary ledger you have to worry about because you're not extending credit at all to customers. You don't have to worry either about collecting from customers. The only downside is that there is a fee involved. Now, the other difference is if you are factoring, you still extend credit to customers, like we said, so you would have to worry about before you make a sale to a customer to check to see if they're credit worthy, where with if you allow credit card sales, you don't have to worry about a customer's credit worthiness. That's on the credit card company that issued the credit card to the customer in the first place. All right, so continue watching where we will talk about notes receivable.